Hello, everyone, and welcome to Virtual Vision Finance Conference brought to you by Ultimate Fintech. My name is Michael Pearl, and I'm a Fintech marketing specialist. Some of you probably remember me from my time at Finance Magnets. So I'm honored to once again moderate this reputable CEOs panel, this time in a virtual manner. So if you hear kids screaming in the background, just ignore. We're wrapping up this super turbulent year, but also a pretty lucrative one for many brokers. And we gathered here leaders of some of the largest industry firms to share their view on this constantly evolving world. We'll talk about volatility and volume spikes. We'll talk about the looming recession. We'll maybe even talk about the vaccines and a more brighter future, and many more to come. And finally, we will assess on how will the industry look like in 2021, which is right around the corner. So with no further ado, I will hand the mic over to our panelists, and I will allow you guys to introduce yourselves. So right at the left of me is Jacob Plattner. Please take the stage. And you're on mute.
Yes, thank you, Michael. My name is Jacob Plattner. I'm the Group CEO of Scope Markets.
Iskandar?
Thanks, Michael. Name's Iskandar Najjar. I'm the Group CEO of Equiti Group, financial brokerage focused on retail and B2B as well as the institutional business. And we're a global player all the way from the Middle East through to Europe and Africa.
Alex?
Yeah, right. Thanks, Michael. Alex MacKinnon, CFH Asia, CEO of CFH Asia. We're a B2B broker, and that's me.
And last but not least, Harpal.
Hello, everyone. I'm Harpal Sandhu. I'm CEO of Integral. Integral is a technology platform that provides services to brokers around the world, including connectivity to their liquidity providers, aggregation, and risk management. We've recently also announced a joint venture with Jefferies Securities called TrueFX, where we're bundling our technology together with credit and liquidity to make running a brokerage operation much more convenient and cost-effective for brokers around the world.
Thank you, everyone. So let's start with a little overview of the state of the industry, so to speak. We can almost start 2020. And in very general terms, how can you summarize the impact of COVID on the industry? Would you say the industry continued growing? Has it plateaued? Or maybe it declined? And I would really appreciate a very elaborate answer to see all nuances. Was the industry matter? So who wants to go first?
I'm happy to touch on that, Michael.
Sure.
If anyone doesn't mind. I mean, it's been a surprising year. We kicked off this year with a lot of plans, a lot of strategies in place, and in some parts, many of those were executed despite the challenges that we went through. The fact that we're in a large part an online business, I think that transition was fairly seamless considering the challenges that we would have anticipated on paper. The initial challenge kicked off early in March, I think, when we had to transition to work from home. We have around 6 or 7 offices around the world, so local policies or local government policies were very different from one region to another. And we had to adapt them as best as we can, keep it as centralized towards the group as best possible, but also localize them in the best way possible. And it was surprisingly far smoother than we had anticipated. Working from home, since we're a global operation, we don't have one single center across the board. We have different functions sitting either in London, either in Jordan, in Dubai, in the US in some parts, and we've been operating on Zoom and operating on Teams for the last 3 or 4 years. So that transition was fairly smooth. When it came through to the industry and the market volatility, I think that was also something that the impact of 2015 gave us a lot of learnings, a lot of experience to be able to feed into the market volatility that came through in March and in April. So what we would have anticipated significant turbulence and significant internal challenges, they were in a large part fairly manageable considering the extent of what we had witnessed over that period of time. The main challenge was dealing with working from home and what that brought with it in terms of maintaining employee morale, maintaining employee motivation, keeping that concentration, keeping that focus, feeding into the unknowns of when, if there was a second wave at the time, whether that was coming, to what extent it would be coming in, and different countries dealing with lockdowns and restrictions in different ways and managing through that.
Thank you, Iskandar. Jacob, same question. I'm curious to hear how was the industry affected from your point of view?
Yeah, I mean, I think, listen, Iskandar touched on a number of points there. Without going into so much more detail, I think the industry itself was set up to prevail, from a technical standpoint. Technology has gone a long way in our industry and evolved, and a lot of the business tends to be global business. So we all, I think, have offices located throughout the world, which puts us in a pretty easy spot to be able to deal with some of the things that obviously brick and mortar businesses cannot. In addition to that, we had more people working from home online with devices in front of them and just ready to eat up a bunch of news. And, at the end of the day, that moved markets and that helped our business. And, I think in general, we're probably a very lucky group of people to have businesses that can prosper in times like these. So from an industry perspective, I found it to be, as a business, very, very good. From a strategy perspective, man, what a difficult year to try and execute. Every day in some cases we're different than the next, whether it's trying to be work from home, trying to keep up with, all of the different things that we would look at where you don't have kind of all of your troops in your offices, but working from home and trying to manage. So very difficult year to execute strategy. I mean, looking ahead, I still find it difficult to figure out, how we're going to get everybody back to offices and start pushing, kind of more of a local or regional, offering, which is something that we had been looking to do for a long time, which was just destroyed this year in terms of trying to execute. But from an industry perspective, technically and where we are in, our, I would say our industry cycle, we're in a very lucky spot. And I think, most of the other panelists would agree.
So that's my following question. Jacob, you mentioned obviously the positive things, not to say the positive things about the pandemic, but obviously the positive effect it had on the industry. But I'm curious to hear if any of you see any negative effects on the industry, any parts of the industry that were affected in a negative way, where you saw a decline maybe in business?
Maybe I can grab that. I mean, from an industry perspective, from a B2B side, I don't see there's been too much decline in the business. I think there's been more interest in family offices getting into the speculation of foreign exchange, CFDs, leverage products. They see there's opportunity there. From a retail side, I'll probably throw that to Jacob, but I think from what our understanding with the retail brokers, it's been record years for client acquisition. So as both Iskandar and Jacob picked up on it, our industry is in a very good spot. We're not a brick and mortars business. We don't have supply chains, etc. Our supply chain is the internet. So, we've been very lucky to be probably one of the only industries around to not to be greatly affected by COVID. Actually affected in a positive way in our returns and volumes for the year.
Interesting. Harpal, I wanted to ask you, and later on this question is open for everyone, what kind of structural changes have you made, if any, in the company to to mitigate the effects of COVID? What did you change? Which let's say departments did you add or increase in terms of manpower?
Yeah. Well, first of all, I'd echo a lot of the observations that the other panelists have made. The customers, or our customers were at home. And so they had a lot of time, and it's obvious now in hindsight that the trading volumes just went up dramatically. A lot of that is witnessed even outside of the FX markets. You just look at the equity markets in a number of the countries, and particularly here in the US, they've just been off the charts. So I think we were just fortunate being in the right place at the right time in an industry that supports people that use our products via the internet, and B, can use our products even more when they're working from home. So it was sort of a perfect storm in terms of the upside to our businesses. From our perspective, unlike what maybe other technology and service providers offer to brokers around the world, we have always been 100% cloud delivery service offering. So we've never really had on-premise software. There's nothing been customized. We never really had to visit a customer to support the technology. So when we were all forced to support customers remotely, we didn't honestly actually change that much. I think the biggest impact to us was our inability to meet together at a whiteboard in our offices in Silicon Valley primarily, and just innovate. So whereas innovation probably in terms of new design concepts and so on takes a little longer. It's harder to do things in groups of 5 or 6 or 7 over Zoom. 2 or 3 people are fine, but after that it's difficult to sort of ad hoc create things. Otherwise, we didn't really change that much. I would say one observation that we made in the market with this change was really interesting, is that any semblance of opposition to full-blown automation and cloud-based services and offerings got completely wiped out within the first 60 days of the pandemic. So anybody that used to think, hey, I want to do something customized, or I want to have something on premise, or I'm concerned about this thing, or all gone. I mean, if you could get something up and running within 2 or 3 weeks, if you could access more liquidity, if you could get a larger net open position with your credit provider, if you could reach your customers faster and onboard customers faster, everybody signed up for it. So it was, I don't think we're going back. I think now that people are using cloud-based, really scalable solutions to have a competitive advantage, I don't think they're going to go back to the way they were, 10 months ago, 11 months ago.
Mm-hmm. Jacob, I wanted to ask you, you mentioned the work from home environment, and you guys shifting to working from home. But there are a lot of studies now that see 2 main problems with working from home as employers. One would be motivating your employees and supervising them. But the second one, and something that is more acute to the industry, is the issue of data security and information security. How do you guys mitigate that when all your CRM systems and all your clients' database is now at the hands of people at their homes?
Yeah, good question. Working from home has presented a number of different challenges. From a security level, I think we'd already been pretty much on the ball with people either working from home or remotely, and having I think at Scope now we have about 7 different offices. Even myself, from having to work in different offices, and having some either software or some internal bit of information that only I can view from different offices. We were pretty much set up to run all of our infrastructure from almost any point. And I think Harpal kind of mentioned that. I mean, we've been cloud-based since the day I started, and we still, we still continue to be. In fact, we definitely look at the sort of how we, how our performance is in the cloud, even with liquidity, for example, as opposed to, if we were just sitting in a specific data center and what that looks like. But getting back to your question from working from home, a security level was never really a big issue for us. So I think we were very well prepared. And I have an IT team to thank for that. In terms of motivation, I think motivation is always a difficult thing in business, whether you have people in the office or not. And there's different challenges in terms of, having them work from afar to having them work in an office. It's much easier to manage people for, in my opinion, some of the strategy that we want to execute in an office. In terms of dealing with day-to-day work and productivity, I think even from a developer standpoint, we've seen that working from home has some major benefits for them. Some of our development teams seem to work a lot better from home, while same with our customer support. And, but if we look at, for example, sales and a few of the other departments, which are, I think, much more social in general, and also, from a management standpoint, dealing with the rest of the board and executives, definitely much better to work, in the office. But certain departments have definitely, we've seen, progress and actually improvement in terms of working from home. But in general, I think, as Harpal mentioned, we're going to see some level of this continuing for a long period of time, whether it's working from home or how we interact technically, as it compared to where we were, just at the beginning of this year.
Thanks. So just to wrap up this COVID focused chapter, and I promised you guys some optimism closer to the end, the end of the topic, not the conversation. So as you probably all heard and saw, we're headed towards I wouldn't say COVID-free world, but we're headed to a hopefully much better world in 2021. We have the vaccines, cross fingers, in the beginning of the year. So if we're optimistic and we see 2021 as the year that will, let's say, diminish or at least, if not end the COVID pandemic, what will happen to the industry next? Because as you all mentioned, March was a very positive turning point for the industry. People were more confined to their houses and they traded more. Now that they are going to go back to work, go back to partying and going about their lives, how will it affect the industry? What are we expected to see?
Yeah, I think you're going to see the industry continue to grow. However, I think the industry itself has been maturing, is still maturing, and growth rates might, not be as high. But I think, for the last 5 years, we've seen consolidation, and I think we're going to continue to see consolidation pick up due to the fact that, there's a lot more people in, that sort of, I think, are now looking at the trading and financial products. But with that being said, I think the treasure chests of some of the biggest brokerages and even some of the medium-sized ones have just gotten bigger, and you're going to see consolidation continue because, it's going to be one of the most effective ways probably in our industry to buy market or to get market share. And, I think the likes of, some of like the Robinhoods have just made trading more significant, probably more appealing to a large number of potential clients. So, I think going forward, I don't think the vaccine has so much to do with how the industry will, grow or not. I think the life cycle that we've been on will continue, and we'll see those points continue to follow.
Okay.
One thing I'd like to say about this, it depends. So what things look like in 21 and onwards in terms of the bump of customer participation depends on whether we look at the customers, the new customers that have come into the space, coming here because of what's called substitution effect, meaning they couldn't do other things for entertainment. So then they picked up, retail trading at home in whatever asset class, or it was actually exposure, and they've actually learned something new. And they've learned, that this is actually an interesting way of either, whether it's entertainment value or it's actually investment ideas. And on that space, I would say at first it obviously looked like substitution because they were at home and they had to do something, so they just started doing this. I actually think a generation of users, a generation of traders, has now been introduced to this kind of risk transference and this kind of speculation that they've now been educated about. So if you look at a lot of times in history, it takes some kind of external event to kind of introduce a population to a new concept. So whether it was Y2K and the whole notion of outsourcing, people said, okay, well, when Y2K is over, people aren't going to have to outsource their IT to India. But once they had outsourced it, they realized it was really cost effective, and they started using it for all kinds of things. I think similarly, people said, well, there was some reason why you might try something, but once you've tried it and you like it, you're probably going to continue doing it. I think the same question is going to come up in terms of online shopping. Is Amazon suddenly going to go back to the way it was in 2019, post the pandemic? I don't think so. I think people have learned these new things and they've adopted it. So that's that's my view on that.
Very interesting point, Harpal. And you actually segued us into the next topic. I wanted to talk about the clients themselves. As you mentioned, we saw an influx of new clients. Some of them weren't exposed to trading at all. And obviously, Robinhood and other equity zero-fee trading apps have done their share. And now we have, let's say, a new generation of traders. So what can you tell us about this new generation? How is it different from people that were trading prior to the pandemic? And what are we expected to see with regards to the engagement of those traders?
From our side, I think I'll second what Harpal said earlier as well. I don't think it's a new generation of traders coming in with a different strategy around trading. I think there's been a lot more noise around the industry in itself, and I think it's similar to what happened a couple of years ago with Bitcoin and the noise that it made around the industry and the accessibility that it's been given to underlying users. It's become far easier. The whole digitalization of a number of different platforms across a number of different industries has really transformed and has been acted as a catalyst for what you'd expect to evolve over 5 years has evolved over the last 12 months or 6 months across a number of companies. And I think the simplicity of using the platforms, accessibility to information, and those education, far more attendees across webinars that we've been hosting and running, a lot of hunger towards education and access to content around that, to be able to self-educate themselves, have a better understanding of how to build their own strategies. And that, alongside the confidence that a number of the users have had over how a lot of the brokers have managed themselves throughout the volatility of the events that have gone through, the seamless transition of client servicing and client experience. It really hasn't disrupted them from trading in February to trading in March and in April. And I think that confidence has increased that client base or that user base of clients coming in. And that's really been the impact of this new wave. I think every few years there is going to be a lot of noise around an instrument, an asset class, or a tool or a product that will bring a whole new wave of experience. I think, as what Jacob had mentioned, I do see significant growth across our user bases over the course of the coming years. The complexity of how to run a brokerage, the costs and the requirements of a stronger balance sheet is only increasing. So consolidation is a natural effect that will be an outcome of all of these challenges. And that's why I think further investments into the client journey, the ecosystem, is what a lot of brokers are, because that client demand is only intensifying. The way that they're shopping through Amazon, the way that they're using other platforms, they're going to have that set of expectations from the brokers that they're dealing with, be it through payment solutions, be it through access of information, be it through access of their funding or withdrawals. And I think that's where there'll be a lot of weight of expectations on brokers such as ourselves to invest further into our technologies to create that ecosystem to make it seamless for them in trading, in using it as a financial services platform.
Mm-hmm. Alex, from a marketing point of view, or from let's say a strategic point of view, what type of clients do you see most valuable right now? Would it be first-time traders, or maybe the good old traders that you have acquired in 2019, or maybe another type of class of traders?
Look, for our business model, the B2B, I mean, our customers stay with us for a number of years, right? So we don't have a high churn or a high acquisition rate, and we're not intensive in the e-marketing channels. But as Jacob and Iskandar's kind of touched on, I think the value will be in the switch accounts, the people who are looking for better service, better customer experience, a better life cycle with their broker. And the one thing I'm a little bit concerned about with COVID and going into next year is, are the clients looking for, cheaper commissions? Cheaper commissions doesn't mean you get a better price or a better service. Iskandar touched on it does cost a lot of money to run brokerage shops. And to provide a good service, you need the customers to understand that they have to pay for it. If we have a race to the bottom in commissions, it's only going to hurt the business. And that will force, consolidation, because smaller brokers will have to take risk. And that means, there's opportunities for clients for brokers to over leverage. And that can be disastrous for the smaller brokers with no balance sheet.
Interesting.
I'd like to bring up a point about this. There's been a lot of talk about Robinhood. And I think it's important to make a couple of observations about them. So just to be clear, Robinhood takes no risk. Robinhood 100%. Now, they do it for regulatory reasons, but the reality is they offset 100% of the trades they do to non-bank market makers sitting in Chicago. They don't take any risk. They don't have to have much of a balance sheet to do what they're doing. And granted, they're a large corporation and they've raised a lot of money and they spend a lot of money. But I think what's important is by not taking risk, by not internalizing flow, they really do just focus on their customer, and they have significantly advanced the customer user experience in terms of onboarding, in terms of the actual interaction with the customer, the ongoing engagement with the customer in terms of the trading experience, the news, the social aspect, and so on. I would, venture to, I don't want to put a name to it, but they really have done a very effective job in gamification. The point I would make about FX brokers, and I know this is debatable, but if you look at the market caps of FX brokers who have attempted to or have gone public, the public markets value them a lot higher if they do not have volatility to their earnings, which are associated with internalizing flow and booking flow. Those that have outsourced that function to market makers, to liquidity providers, have significantly higher valuations, have a much, much lower need for capital, and focus on what they should be focused on, which is customer acquisition, marketing, and all the rest. So I actually think you may have a situation going forward if there is competitive forces starting to put pressure on brokers, that brokers may look at models where they end up outsourcing a lot about what they do and focus on the key element of acquiring customers. So they could outsource liquidity, they could outsource technology, and they may even outsource a lot of their other operating aspects, which will bring us to the last point, is that if people are able to outsource them and service providers emerge that can do this at scale at a very, very low cost, you will actually lower the barriers of entry to new entrants coming into the market, because they no longer have to have all of this massive legacy infrastructure that brokers have built up over all these years, because they can now just use it in the cloud.
Very interesting, and it will be extremely interesting to see whether this trend continues in 2021, definitely. And once again, Harpal, you segued us into our next topic, which is regulations.
You're welcome.
Yeah. It's as if you're assisting me here. So I wanted to ask you, you mentioned Robinhood and some of the focus that it got recently, both in terms of, the most evident influx of clients to Robinhood and its effect on the general equity markets. But it also attracted a lot of spotlight from the media, and especially with this unfortunate case of a person committing suicide due to a bad trade. Do you think that some of that focus will spill over to FX markets in terms of regulations, in terms of oversight of the regulators?
From our side, I think we've already witnessed that over the course of the last couple of years, and with the key focus of the regulators being on client suitability. The world is very, very different to where it was 5 years ago in terms of onboarding clients, internal controls, risk and governance. The conversations that we have today at a board level are very, very different to what they were 3 or 4 years ago. And I think the regulators' view on that has really been directing and ensuring that risk controls, governance, client suitability is at the DNA of all of the brokers in driving their strategy and delivering their message and in rolling out those products. And I think that's key towards the future of our business. And I think that's what's also building confidence around the sector, that it's no longer what it was some years ago. Will it continue? I think yes, I believe so. I think access to data, the transparency of the reporting, the importance of reporting within organizations today, and what the regulators are doing with that data and what they will do with that data in the coming years, I think is really going to be setting the precedent about how this product is designed, regulated, and viewed in the near future, most likely.
Yeah, I mean, I think touching on that, regulation is one of those things that our industry has had and at a significant level in, most of the places where I think brokerages are going after clientele. And, the regulatory environment, I think, is going to continue to evolve just as the industry has. And I think one of the things that we still have probably more so, than we probably should at this moment, is we still have plenty of bad actors in our industry that give it a bad name. Whether the way they target clients, what they offer clients, and then therefore how they treat clients. And I think at a retail level, this is something that the industry needs to come together and continue to clean up if we're going to sort of grow and gain. I think, Harpal touched, these substitutive clients that we've now gained, and I think rightfully so, have also been educated along the way. Those clients now need to be looked after by not just companies like ours, but by all of the companies offering services to these clients. From B book to A book, I don't think it's really has a huge impact to the retail client at the end of the day. I think the way companies such as ourselves manage our clients, manage their expectations, and provide regulation, provided through regulation, are treated fairly and understand what they're getting themselves into, then we should see this, I think, thematic continue to evolve in our industry. But really, the more we're able to police and get rid of the bad actors in our industry. And I think, crypto kind of has this coming, right? Like, I mean, all of us in the FX industry have kind of seen this, and, we're hoping, from a crypto standpoint, especially around some of these, stable coins, that we don't see any issues or, fraud, which could possibly, bring another big black mark to the industry. And I think, that's the main thing that I don't know if regulators, whether it's the FCA, whether it's ASIC, whether it's SISIC, are going to be able to prevent something like that. I think that's more, us inside the industry that have to continue to try and give it a bigger and better name for itself. And I think regulatory wise, the regulators will evolve a little bit behind us, trying to make sure that, it continues to be a product that can be regulated.
Yeah, I agree with that. I don't think we want to be, we shouldn't be scared of regulation. We don't like over-regulation, but having good regulators, and I think the major regulators around the world see that, and it makes the business a stable business. And it only provides a better product for the clients, particularly retail clients, and a safer product for them in the long run, which means we have more stable businesses.
Mm-hmm. Let me ask you guys slightly more macro question. We're a little more than a month after the elections in the US, and we're headed towards a new cabinet, a new administration, and we already start to kind of see the general lines of this administration. We can already see who will be in charge of most offices. Would you like to, I don't know, bet whether it will have an impact on the industry? Are we expected to see a different approach towards, let's say, the financial world in general, and more specifically the FX industry?
There was a chance that there would have been some significant shift in that had Elizabeth Warren come in as Treasury Secretary. But now that Janet Yellen, has been named, and we know her background. I don't think there's going to be any significant change. Gary Gensler was appointed as the head of the transition committee for, the finance side of Biden's transition team. And if you recall, Gensler was the head of the CFTC during the Dodd-Frank implementation. And he actually took a pretty hard line on financial institutions, particularly with capital requirements and so on. Now, he was eventually stymied by Republican members of the CFTC. So, a lot of the things in terms of mandating to trade a number of the FX derivative products, or mandating to clear a number of the FX derivative products, never happened. So now that Yellen is in there, I actually don't think anything's going to happen. In fact, there'll probably be less happening and less spending and a much more austere U.S. government spending cycle over the next 4 years than in the previous 4 years, primarily because Republicans can revert back to being deficit hawks, whereas when their own president was spending like a drunken sailor, they could go along with him. Now, if Biden wants to spend, they'll revert back to the way they were during the Obama years and probably constrain, spending a bit. But I really don't think the Consumer Protection Bureau, the Consumer Finance Protection Bureau, is going to do anything either in terms of impacting, retail side of the business.
Yeah, I would echo that. I don't see any real change for our business based on the election itself. I think some of the policies that Harpal mentioned, sort of what happens with credit, what happens with spending, how much do the sort of, one of the most important questions that's still yet to be answered is, where does the Senate lie? Is it a Democratic Senate or is it a Republican one? And a lot of that, I think we'll see. Obviously, in the next 2 to 3 weeks, we'll get an understanding as to what that looks like. But in terms of, I think, our general business, there's not much impact. Certainly, there will be impact around the assets that we all price and the assets that we all offer clients. But in terms of our general overall impact, I think it's very small.
Thank you. So, Jacob, you mentioned crypto earlier. And, let's take 2-3 years prior, crypto was a huge thing in terms of an offering, and also in terms of liquidity, is a liquidity challenge. How do you guys view that asset now? It's kind of been on the down low until recently. Now Bitcoin is back in the news. So I'm curious to hear how you view this as an asset now.
Yeah, I mean, I think crypto from at least a retail perspective is huge and only getting bigger. You know, I don't know if it was much of an issue around liquidity. I mean, certainly we didn't see much of an issue around liquidity or sourcing pricing and, you know, the major coins. In fact, even the future product relative to, you know, the underlying product came out very, very quickly. So from that standpoint, I don't think there was ever much of an issue, but I think crypto is here to stay. I mean, it's not a huge product that we offer. We get more and more demand for it, but certainly our retail clients are paying attention to it, looking at it. Anytime we have content, you know, around crypto, it's heavily picked up. And I can say, you know, it's starting to tick over in terms of volumes for us, but I don't see how anybody can say that crypto isn't here to say, and, you know, we're not going to see more and more virtualization of money. I think, you know, that's it hasn't been shut down and it won't be. Where it goes, I'm not quite sure, to be perfectly honest. Maybe some of the other panelists will have a better idea than me.
Iskandar, I'm curious to hear what you think about it. Your take on crypto.
I think I second what Jacob is saying here. It's somewhat different to where it was 2 years ago. There has been a lot more confidence around it. A lot of institutional investors have been participating. A lot of hedge funds have been participating in it, and the demand is there. And with market volatility, with the adoption by PayPal, it is making a lot more noise. It is an asset class that clients are looking for. We're looking to offer it quite soon as an OTC liquidity as opposed to DMA liquidity. But what structure, where it's going to be in 3 years, I definitely think it's going to be an asset class that there will be continuous demand, a lot of noise around it. How it would be regulated, it's still a large unknown, and what type of controls will be around is still very much of an unknown as it was 2 years ago for us.
So
yeah,
go ahead, Alex.
Yeah, please, no problem.
I'll probably lead into what you want to say, Harpal, but yeah, it's definitely an asset class that's going to stick around, and as you touched, Michael, probably the issue is around liquidity. And if we go into the piping of liquidity from a deliverable point of view at the moment, you know, how do you actually change from one exchange to another, you know, if you're long or short there. So the deliverable, as we would call it in FX, the deliverable risk of making payments against different exchanges is the biggest concern we have. And, you know, still, banks don't like it if you're sending money to crypto exchanges, etc., for payments. So we keep out of that physical market. We're always in the OTC market. So the underlying business, as it is in, say, in gold has a very fungible product globally. It's an e-warrant system, or it's governed by the LBMA or certain bullion exchanges, memberships around the world. So maybe, you know, crypto will need to go that way, where, you know, centrally you're regulated in your jurisdiction and there's some sort of backing behind your deliverable and, you know, payments ability. And then you've also got to throw the governance of AML and TCF in there as well. And what's the reliability of that exchange to you know, control their own AML issues.
Yeah.
Thank you.
I think Alex has hit on, a number of the really salient issues as to why crypto is difficult to sort of integrate, particularly on the deliverable side, and offer it up to customers. I will say that, you know, Integral faced the same issue, which is why we sponsored the creation of another company called Mint Exchange, which actually built out a lot of the infrastructure associated with custody, clearing, and settling of physical crypto, because the banking infrastructure, you know, wouldn't do it. So Mint today acts as, you know, a type of a modern day crypto prime broker, allowing people to keep capital in a single centralized place, and then have Mint essentially execute as an agent on behalf of the customer on a transparent basis with exchanges around the world. So that way the customers don't actually get exposed to the exchanges. But having said that, I think crypto, we should really, expand how we look at the opportunity as three pieces. One is stablecoins, which are digital versions of fiat currencies. And a lot of the issues that people are talking about in terms of funding, payments, and so on might very well be solved with the use of these proxies for underlying fiat. Now, there are clearly issues with it about whether there's a one-to-one reserve and whether we trust the reserve entity and so on. But those issues are being solved as banks, particularly in the United States, under the OCC order that came out around 2 months ago, roughly 8-9 weeks, that are now allowing banks to hold crypto as collateral for token issuance or tokenizing that underlying collateral, so essentially stable coins. So that's one aspect of crypto. The second aspect that we talked about is physical crypto trading, which have a lot of complexities associated with them, associated with settlement and so on. But we mentioned that those are being solved. The last, and I think it's really quite interesting, and I think a number of the brokers are involved in it, are CFD or derivative versions of crypto that are traded. So non-settlement, risk units. And in that sphere, in places around the world where crypto is being heavily traded, it is 80 to 90% of the volume that is happening. So it's actually a really, really quite large business. It's very successful, not unlike CFDs in other markets, equities, equity indices, and so on. So I think it's going to be, quite interesting. There's one last note I want to bring up about this. Crypto is innovating really very, very quickly. And there are things that we can learn from the crypto markets because those guys on that side have to deal with so much more friction, so much more difficulty, and so much opposition from regulators around the world. The innovative solutions that they're coming up with in terms of working not necessarily around these problems, but solving the problems in a technology-oriented way that allow their users to do things is really phenomenal. And I think we will start to see some of those innovations come over to the FX space. And that'll really be quite exciting in the next year or so.
Yeah, we're almost out of time, and we have time for one last summarizing question. Some of you touched upon the issue of what we're expected to see in 2021, but I really want to focus you ahead of this question. And I'm trying to kind of get a picture of what we're expected to see. Will we see more consolidation? Will we see more of the smaller players, not making it and eventually selling their shops, or doing some other types of mergers, or are we expected to see an expansion and more new players going into the market? Are we expected to see new clients flowing in? Are we expected to see more volume, or vice versa? So, along those three vectors, please let me know what's your take on it. And we'll start from Iskandar.
I think in preparation for 2021, for us, is mainly focused internally about how to manage around the lockdown, how to manage about work from home, and continue that motivation for staff to have that energy, that dynamism going forward. No one really had a summer vacation. No one had, no one's it's looking like they're not to have a Christmas vacation. So how do you keep that energy? How do you keep that dynamism going forward? And I think that feeds into Q1 and Q2 of next year. On the overall picture, I think that's the biggest investment that we're putting into a lot of the resources that we're feeding into that. When it comes to consolidation, personally, I don't see that happening in the early stages of 2021. I think as a lot of brokers had a successful year, I think we're going to see a lot of investments into new products, investments into new campaigns, a lot more noise around the industry being made, which is going to bring an influx of new traders coming through. A lot of marketing bucks are going to be spent over the course of Q1 and Q2. Market volatility, I think that's an element of unknown. With the new administration coming into the US, and how's that going to impact volatility? And I think that's really been a dictator. Market volatility has sustained itself over the course of H2 of this year. That was somewhat of an unknown based on what we've seen in H1 of this year. And we anticipate for that to feed into Q1 at least of 2021 moving forward. I think Harpal had touched on to one piece earlier. What's been challenging this year is not the operation and execution of operations, but it's more about strategizing. All of us sitting around the table, being able to brainstorm and come out to what's next and what comes through next. And we've been able to transition, we've been able to grow, but not at the rate that we would like to grow. And I think that's one key factor that's going to be feeding into 2021. What we can achieve with that is as soon as we're able to sit around the table together, as soon as we're able to sit down in one single office, is really bring all of those plans in line and bring them to life. And I think that's really going to be feeding into Q1 and Q2 of 2021 for us.
Sorry, thank you, Iskandar. Jacob, what's your take on it?
Yeah, I mean, well, to answer your questions somewhat directly, in terms of next year, I mean, I see more consolidation. I think, for sure, the market and the industry are more competitive. It's more costly to run businesses. From a technical standpoint, not as much, but certainly from a regulatory standpoint, it's significantly more costly. In terms of what I would expect to see from the industry in general, I mean, I think it's like we've touched on, it's going to continue to grow. There's going to continue to be more content related to finance. It's going to be a very big topic next year for politicians is to, I think the big question everybody's already asking, it has been for, 10 months now, but when will there be a vaccine? When will we all go back to our normal way of life, which I think normal going forward has definitely changed. But, the big question will be for us, how do we keep everybody safe continually from this pandemic? When there is a vaccine, how do we get people back into the office? What strategies do we carry out first? We're in places in Southeast Asia, Africa, where, being on the ground is very, very effective. And, we're going to be looking at places where we try and implement strategy where we haven't been able to for what will probably be 10 to 18 months. And I think the rest of the industry is going to, be doing a lot of the same, trying to figure out how they get back to some level of normal when it comes around, and how to keep their staff safe, and how to continue to make a product that is, I think, fairly stable now, better. Regulation, I think, will also continue to play a balance in what we see from the industry. But I think these are things that we've seen for the last 2 or 3 years. The only difference is really COVID, and how we work as a global business and a global workforce is definitely yet to be, I think, understood. And I think that will be a big theme to what happens in 2021.
Mm-hmm. Alex?
Yeah, I kind of agree with Jacob there. I mean, and Iskandar, the plans and the innovations and the products, etc., we've been looking to, but we would have developed or deployed this year has all been delayed. So the first 6 months, 9 months of next year, I think it's going to be very, very interesting to be and exciting to be a client, be a retail client or an institutional client. I think technology firms, brokers, everybody will be coming out with new campaigns, new offerings to try and capture, the new clients that are out there that have caught the interest of FX and leverage products. Let's not just keep it to FX, right? We're indices, we're energy products. I think there'll be a lot of innovation coming out in how to maintain and create that customer experience, continual customer experience to satisfy the clients, along with possible new products. Who knows what they may be, but I think everybody's probably got a list of 10 to 12 things to do they want to do tomorrow, but it's when can we get it done with a very decentralized workforce now.
So I agree with what Alex, Iskandar, and Jacob have said. I think it's going to be all of the above. The world is awash in cash, and while the central banks maintain their mandate of reemploying the millions of people who have been sidelined by the pandemic, they're going to keep interest rates low for the next couple of years. So with all of that cash, you see an increased appetite for risk across the board. And that risk will show up in lots of different ways. It shows up in the equity values of these public companies. It shows up in people speculating with their own money in terms of the retail trading that we're seeing. And I think it will come everywhere, and especially in our industry, with people taking risks on new business initiatives. So whether they be campaigns or additional products that people come out with, or going after additional regions or segments of the world or customer segments. It'll also come in the form of consolidation, but not necessarily consolidation because people can't survive in the business anymore. I think everybody's awash in cash also from their revenues. So there'll be consolidation because some of the players will see, to take on more risk in terms of spending a premium, acquiring someone else to expand inorganically. But at the same time, I think people look at this FX or whatever we call it, rolling spot risk units across asset classes, which is what the FX brokerage industry has evolved into. They see this as an attractive global channel to reach retail traders. And I would not be surprised if new entrants come into this market, just as we saw happen in Japan over the last 5 or 10 years, where internet companies like Yahoo, Japan, GMO, and others who were not traditional FX players entered the market because they saw it as a good market. So I wouldn't be surprised if, I'll just throw it out there, but PayPal shut down 150 or 200 accounts on their new crypto offering because people were exchanging crypto so fast that they were afraid that PayPal might be regulated as a trading operation or as a broker. And at 2% per trade, it's quite a good business to be a broker in that space. So, whether it's people like PayPal or it's Google or it's Facebook with their, Libra/DM product that is coming out, trading is a way to keep people engaged, occupied, and entertained. And there's money to be made out of it, whether it's through monetization of the flow or advertising or what have you. And the business has expanded a lot. I think it'll continue to expand. It'll be super exciting for the next couple of years. And I think a year from now, we'll look back and everybody will be talking about, especially these guys up along here with me, will be talking about all their great exploits that they had over the past year of new projects and campaigns they rolled out and how much of a hit they were. So I'm looking forward to it.
Thank you. So on that positive note, we're unfortunately out of time. Thank you all for participating, and we'll see you in our future events. Thank you so much.
Look forward to it. Thank you.
Thanks, guys.
Thank you. Bye, guys.
Bye.
Bye-bye.